Well, natural gas attempted a bullish reversal on Monday, briefly breaking out to a 6-day high of $3.20 before sellers regained control and pushed prices back toward the $3 level. Although futures rose more than 4% earlier in the session, the rally faded as traders reassessed demand prospects against strong underlying supply. From a fundamental perspective, the initial upside was driven by expectations that a powerful winter storm in the Northeast would significantly boost heating demand. Severe snowfall disrupted transportation and increased consumption for both heating and power generation. Meanwhile, LNG exports also provided support. Pipeline flows to export facilities climbed to 20.2 billion cubic feet per day on Sunday, roughly 24% higher than a year ago and close to record levels. Average flows to the 9 major U.S. LNG terminals reached 18.6 billion cubic feet per day in February, reflecting sustained export strength. However, weather forecasts from the National Oceanic and Atmospheric Administration indicate a shift toward warmer than normal temperatures in the coming weeks, which could weigh on demand. At the same time, production in the lower 48 reached a record 108.7 billion cubic feet per day, reinforcing the perception of ample supply and potentially limiting further price gains. Attention now turns to the upcoming EIA storage report. Market expectations point to a relatively small 54 billion cubic feet withdrawal compared with the 5-year average draw of 168 billion cubic feet, a notably bearish comparison. Much of this has likely already been priced in after the recent decline toward $3. Current projections suggest the storage deficit could increase back to 66 billion cubic feet. Traders will closely monitor whether this trend continues and how the recent winter storm ultimately impacts inventories. Technically, short-term volatility has become more frequent since late September. Monday's move was brief, lasting only one session, but it reinforces the risk of sharp price swings in either direction. Key levels remain critical. Support stands near $2.90, which marks an important recent low. On the upside, $3.20 is a pivotal level, representing a lower swing high within the broader downtrend that began from the January peak at $4.40. The structure of lower highs and lower lows remains intact unless this level is decisively broken. A sustained recovery above $3.20 would improve the technical outlook and expose the next resistance levels at $3.50, followed by the 200-day moving average near $3.71. Until then, natural gas remains caught between strong production and fluctuating weather-driven demand expectations, with LNG exports continue to offer support. If you're looking for a more detailed breakdown of the market, consider joining the channel. Members get early access to new videos, so you can see the analysis before everyone else. Thanks for being here, see you in the next update.